Hey everyone, welcome to The Explainer. Today, we are cracking open the ultimate strategic wealth building playbook. Choosing between a Roth IRA and a traditional IRA is arguably one of the most absolutely crucial decisions you're ever going to make as a retirement saver. And with new rules coming into play, we're mapping out the exact 2026 traditional versus Roth IRA landscape. Think of this explainer as your ringside seat to the ultimate financial showdown.
Okay, let's dive right into this because the core difference between these two powerhouse accounts basically boils down to one simple million-dollar question. Do you want to pay taxes now or do you want to pay taxes later? Everything we're about to cover hinges on exactly how you answer that question for your own life.
So, here's the tale of the tape for today's showdown. We'll meet the contenders, look at the strict 2026 rules and limits, break down the strategic decision framework, and finally, unlock some advanced tactics. All right, round one. Let's meet the contenders. Traditional versus Roth.
In the red corner, we have the foundational model of American retirement, the traditional IRA. Now, this one is all about maximizing your current cash flow by giving you an immediate break on your taxable income. Imagine you're earning 85 grand in 2026, right? If you max out your contribution with pre-tax dollars, you get to deduct that from your gross income, instantly lowering your tax bill today. Then, your money grows in this amazing tax-deferred ecosystem. No taxes on gains or dividends as it compounds over the years. But here's the catch. When you finally withdraw that money in retirement, every single dollar is taxed as ordinary income.
And over in the blue corner, introduced back in 1997, we've got the Roth IRA. The Roth completely flips the script. It prioritizes long-term tax freedom over short-term relief. You're putting in after-tax dollars, meaning you get zero upfront tax breaks today. Your taxable income doesn't change one bit. But ma'am, the payoff is staggering. Because you paid your taxes up front, both your original contributions and literally decades of compounded earnings are 100% tax-free when you pull them out in retirement. No taxes, zero.
Honestly, the absolute best way to conceptualize the difference is the classic seed versus harvest analogy. It's like farming. The traditional IRA taxes the harvest. You get the seed for free today, but you're giving a massive cut of your future crop to the IRS. The Roth IRA? Well, it taxes the seed. You pay a little bit upfront today, but your entire future harvest is fully and completely shielded from taxes.
Moving on to Section 2, the 2026 rules and limits. This is the arena we're playing in.
For 2026, the magic number you really need to remember is $7,500. That's the combined maximum amount you can contribute annually across all your personal IRAs. Now, if you happen to be 50 or older, you get an extra $1,100 catch-up allowance, which brings your total limit to $8,600. And you've got until April 15th, 2027, the standard tax filing deadline, to actually get those 2026 contributions locked in.
Let's talk age milestones, because these act like the referees in this arena. At age 50, as we just mentioned, boom, you trigger those catch-up limits. Then, age 59.5 is this magical threshold where you can take standard withdrawals without facing a brutal 10% early distribution penalty. And finally, there's age 73. That's when the IRS steps in and forces your hand with the traditional IRA, requiring you to start taking what they call required minimum distributions, or RMDs.
Now, what's really fascinating is how the IRS actually restricts who gets to play the game, and it's all based on your modified adjusted gross income, or MAGI. Say you or your spouse have a workplace plan, like a 401k. If you're a single filer in 2026, your ability to deduct traditional IRA contributions phases out between $81,000 and $91,000. But the Roth? The Roth doesn't just phase out a deduction. It completely bans high earners from contributing directly at all. If you're single and make over $168,000 or filing jointly and making over $252,000, direct Roth contributions are legally forbidden. So what happens if you break the rules and need your money before you hit age 59.5? Well, the traditional IRA hits you hard. Unless you meet a few very specific exemptions, like buying your first home, you're going to pay ordinary income tax plus a 10% penalty on those withdrawals. Ouch. The Roth IRA, though, operates on a super generous ordering rule. The IRS assumes the very first dollars you take out are your original after-tax contributions. This means you can pull those specific contribution dollars out completely tax-free and penalty-free. All right, Section 3, the strategic decision framework. This is how you actually win. It really all comes down to tax bracket arbitrage. It's kind of like a time machine for your money. If you're in your peak earning years and sitting in a really high tax bracket right now, the math says go traditional. Take the deduction today while your taxes are sky high and withdraw later in retirement when your income and likely your tax bracket drops down. On the flip side, if you're early in your career, maybe working part-time or just in a low tax bracket, you gotta choose Roth. Pay that low tax rate today and lock in completely tax-free withdrawals for a future where career growth, or even just shifting tax laws, pushes you into a higher bracket.
So the crucial point here is understanding what I like to call the Roth's liquidity superpower. Because you used your own after-tax money, you can withdraw those original contributions at any time for literally any reason without owing a dime in taxes or penalties. If you suddenly need an extreme emergency fund buffer or you're planning an early retirement, this gives you a pristine safety net that the traditional IRA just cannot duplicate.
And get this. The Roth IRA is arguably the finest generational wealth tool in the entire tax code. Why? Because as the original owner, you face 0 lifetime required minimum distributions. The IRS doesn't force you to take a single dollar out at age 73. You can literally let a massive tax-free bucket of assets compound indefinitely and pass it entirely untouched to your heirs. They can then let it compound for another full decade before withdrawing it completely tax-free. An inherited traditional IRA, on the other hand, that can suddenly thrust your heirs into their own peak tax brackets. No thanks. Finally, Section 4, Advanced Tactics and Hybrids. These are basically the cheat codes. One of the sharpest tactics out there is running parallel accounts. A lot of people don't realize this, but it is totally legal to maintain both a traditional and a Roth IRA at the exact same time. You just have to make sure your total contributions across both don't exceed that $7,500 limit for 2026. This strategy creates what we call tax diversification. It basically gives you 2 different buckets to pull from in retirement, so you can precisely manage your taxable income year by year. And this brilliantly illustrates our final advanced tactic, the Backdoor Roth maneuver. Remember those strict income bans for high earners we talked about? If you make over $168,000 single or $252,000 joint, you can't contribute to a Roth directly. But you can legally do this 2-step workaround. Step 1, make a non-deductible contribution to a traditional IRA. Step 2, immediately convert those funds right into a Roth IRA. As long as you navigate around the IRS's pro rata rule, which just means you don't already have a bunch of other pre-tax money sitting in existing IRAs, you can legally bypass those income limits and keep building that tax-free wealth. There's a great line from our sources for this explainer that says, tax diversification gives you precise control over your taxable income in retirement. And they hit the nail on the head. Understanding these 2026 rules isn't just some boring academic exercise in following IRS guidelines. It's about empowering yourself. It's about optimizing your trajectory, controlling your cash flow, and ultimately keeping way more of your own hard-earned money. So, as we wrap up this explainer, I really want you to take a hard look at your own portfolio, your current age, and your current tax bracket, and ask yourself that ultimate defining question. Are you going to tax the seed today, or are you going to tax the harvest tomorrow? The 2026 playbook is entirely in your hands. Now it's time to make your move.